Hello and a warm welcome to Talking Stocks. I'm Gugulethu, Cele. In studio with me today, I'm joined by Ashton and Fran, Lesar, both from Anchor Capital. Now today we're talking capital and counties properties, a United Kingdom-based property investment and development firm which is focused on sites in the West and West End of London, listed on the London as well as Johannesburg stock exchanges. Thank you so much for joining us, and maybe let's paint a clearer picture on capital and counties, one of those firm favorites with a lot of investors that I'm aware of who want that offshore European exposure. But overall, what kind of properties are we talking about that are under the Capco umbrella?
Sure, Gugu. So I guess it's mixed in a way, in the sense that you've got essentially three key assets. You've got the Earl's Court, where they've got essentially the master plan to redevelop the residential aspect of Earl's Court. There's an asset called Covent Garden, which is a mixed-use destination retail, office, and a little bit of residential, but largely destination retail, food and beverage in the West End. And then you've got venues, which is also mixed use. There's a convention centre there, etc., but it's income producing. Covent Garden is the real rental asset at this point in time. It's driving probably £86 million worth of rental income on an annualised basis, but growing quite nicely. And then Earl's Court is the developmental asset that still has yet to be sold off in terms of a number of residential units that they're developing. Mm-hmm.
So do we like it because of that interesting mix regarding the ownership of the property, rental income, together with the development strategies going forward? Would
I think we like it principally because of the location of these assets. They hold probably the best located developmental assets in the United Kingdom in terms of central London, mm-hmm. But also in the sense that there's significant value to be created in Earl's Court via effectively the developmental profits that they can earn from developing at a certain cost and selling off those assets at a much higher value. And where does that developmental profit come by, or why should it come about? Well, because they have the sites. That's ultimately where the value sits.
Give us an idea of the metrics with regard to this particular company. Share price, forward PE, what are we talking about? What figures are we looking at here?
So just from a valuation point of view, this type of business is valued off net asset value per share. And that is really your equity value that sits in once you take the gearing off your assets. And so currently it's roughly trading at about an 11% discount to net asset value, which is quite unique because historically this traded in excess of 20 to 30, depending on the cycle that you were in, the property cycle that you were looking at. At the moment,
and that's a premium.
And that is a premium, and premium rated assets. And at the moment, what you've seen is due to the noise around Brexit, any UK-based equity and property falls under that umbrella has seen a significant derating in valuation. I mean, I think Capco at the moment for the last quarter is down 30%. And so we don't really believe in that valuation, and I think that there is a lot of traction and growth to come through, given what we say defensiveness in the assets, in the fact that the location is defensive. It is central London. There's a natural demand for the area. Earl's Court is surrounded by, say, for example, Kensington and Chelsea, which are natural destination residential areas. So this gives you some sort of valuation underpin. We don't see things collapsing, although you have seen historically in cycles. Post-2008, you saw the London market come off 30%. We've seen this repeat through Brexit. Is Brexit likely to happen? Possibly not in our view. But from a valuation point of view, I think now is a great point to enter into this business.
And I take it that's based on the volatility we've seen in the pound sterling as we head up towards the Brexit referendum.
And you're likely to see more volatility going forward. I think there will be a lot of noise as the vote comes through, I think on the 24th of June. And so off the back of that, there possibly might be other entry points. But for us, it's not about timing the market, it's time in the market.
Let's go back to the net asset value per share regarding the historical performance together with the estimated future growth here. And we're talking double digits here. Is this normal when it comes to the property sphere?
So I think certainly they've delivered about 20% per annum growth in net asset value per share in recent years. I think what we're expecting and modelling on is kind of 10 to 15% uplift in value. And when you look at something like Covent Garden, that's going to come through in what we're expecting to be about 8% rental growth. So they still expect to be able to get quite a lot more footfall, and they are redeveloping some of the streets around Covent Garden from an access point of view. They're putting in new shops. We're expecting to see about 8% rental growth uplift. So that'll get you to about £100 million worth of rentals in FY17. And then we're assuming that their cap rate can compress the capitalization rate, which is effectively the discount rate that you're going to apply to those rents to get you a value. So that's currently at about 4.3%. We're modelling on it getting to about 4%, which is broadly in line with prime London. And that would get you to kind of double-digit value growth for Covent Garden itself. And then where the juice comes from in Earls Court is them developing out those assets and earning that developmental profit, as I'd mentioned.
Yeah. If we do take a look, though, to sidestep at the interest rate cycle coming out of the UK, together with the Bank of England, if I'm not mistaken, is this also playing a dynamic when it comes to the kind of returns that we'll see from property companies?
So I think if you expected that interest rates would rise dramatically in the UK, that could have a detrimental effect on cap rates of property. Mm-hmm. Our view is that you're not likely to see a dramatic and very rapid increase in interest rates. I think from the perspective of funding their growth as well, they're quite conservatively funded. So I mean, their all-in cost of borrowing right now is about 2.8%. But their loan, which might encourage you to have a lot of debt in your business, but as a developmental asset, they don't want to take big bets on raw land. They only want to gear against income-producing assets. So the debt to NAV is still quite low at about, I think it's 16.8%, if I'm not mistaken. Mm-hmm. So very conservative in the use of debt funding.
Mm-hmm. Let's go back to the share valuation very briefly, and maybe if you can give us a further analysis on that, Fran, just to understand exactly how we come about to the discounted value at which it's trading at.
So if you assume a share price of about £3.39 a share, that's just the starting base. Off the last reported numbers, so that was about £3.61. That gets you to roughly about a 6% discount at last reported NAV. What isn't in that number is the valuation for a piece of land in Earls Court called Cele, and that is not in the numbers due to the fact on accounting principles you cannot add or attribute a value to something until you're actually drawing down on the land or the asset, so you're actually using the land. And so if you include that in the numbers, which we do, roughly now at about 20 pence per share, that really brings your valuation up, and that really gets you to that discount of 12%. Mm-hmm. And that'll slowly unwind and be added to the balance sheet as they start to draw down, which we anticipate around midway FY16 to the start of FY17. So that's in our numbers. And that will rapidly unwind to about a 20% discount on today's share price for the FY17 period. Mm.
If we come back, though, to its view of capital and counties versus its counterparts in the industry, how different are the dynamics given the rather muted, or not even muted, but rather clear and cut strategy of capital and counties, which isn't as aggressive as other property developers across the globe?
So I assume you're referring to South African counterparts, is that right? So look, I think what makes it unique is the profile of asset that you get to be able to own via this listed entity compared to all the other listed properties in South Africa. So obviously you've got Into Properties, which is more of a shopping centre business in the UK. South Africans can get access to that. But I think there's other dynamics at play there, in the sense that they're probably a lot more vulnerable with respect to the potential impact of a move towards online from a retailing perspective. So I would expect that could create more of a headache for the type of assets that they own longer term than something like Capital and Counties, which is more of a residential story than anything else. But certainly, I mean, why do you buy this business? You buy it because of the fact that they have unparalleled assets in the centre of London, for which they have the master plan to redevelop Earls Court into a much more densified form of residential units. And ultimately, as we've seen, the reason why you've had sky-high pricing for property in the centre of London is because of lack of supply. Now, it's important to understand that the very top end of UK residential property, which we are seeing some press reports that's coming under pressure. The ultra-luxury homes are coming under pressure from a valuation point of view, but we're talking £2,500 per square foot and above.
Sure.
Now, if you look at where Earls Court is situated, it's adjoining places like Chelsea, but the price points are, I think, for a recent apartment that they've been developing, about £1,400 per square foot and down. And we're valuing our overall valuation for Earls Court, Fran, if I'm not mistaken, is about £900 per square foot. So substantially lower than ultra premium, but with the ability to re-rate if the market starts to attribute Chelsea-like valuations to their key assets.
Fantastic. Well, let's find out now, following that analysis, whether to buy, hold or sell Capital and Counties. Fran, let's start off with you. Buy, hold or sell Capital and Counties?
I'd be a buyer of Capital and Counties at the moment. I think you have seen a lot of noise around the UK equity market, and unjustly so to the share price, so I would definitely be a buyer at this stage. Any
particular levels here, given the graph that we do have regarding the Brexit pressure, giving us a particular range regarding prices?
I'd probably say, as the share price is right now, it's trading at around 70 Rand, really would be comfortable. It is at a significant discount to what it's historically traded at, and so would be very comfortable getting in at these levels.
Sean, your view?
So I think it's a buy. I think you're going to see quite a lot of noise between now and the Brexit referendum. Now, just to take a step back, not many people may be aware, but the concerns around Brexit is that the United Kingdom might leave the EU. There's a lot of office workers that are from the continent that make up a large part of the workforce in London. So the fear obviously is that if they choose to leave the EU, there's a lot of workers that leave the City of London, that creates vacancies for property, etc., places pressure on property values. My view is that bad news is largely in the price now. You haven't been able to buy Capco at a discount to its net asset value for certainly at least 5 years. I mean, if you look at that graph that we showed there, it's been trading at a premium. So the premium rating has come out of it. I think that it's, until we've got clarity, and I don't know which way it's going to go. I think politically, for me to be calling that the UK stays in the EU or not is, I would say it's a 50-50 call.
You'd be brave on that bet,
as the polls suggest. But what I would say is that I think the bad news is in the price, and if it so transpires that they choose to stay, I think that's an overhang that gets lifted from the stock, and you could see it run quite quickly. So for me, it's a buy.
Consensus coming through from the desk that it's a buy for Capital and Counties. A big thank you once more to both my guests, Sean Ashton and Fran Lesar, both from Anchor Capital. Well, that's where we leave things for today as we take a look at Capital and Counties. But join us again next time where we talk more stocks.